Greetings, fellow investors. With oil and natural gas prices cut in half over the past year, it's no wonder the energy sector is down in the dumps. Energy from the sun and wind, however, is still running hot. In fact, even as North America's oil and natural gas producers slash output and utilities are shutting down an unprecedented number of older coal-fired power plants, electricity generation from U.S. windmills is set to rise by 23% over the next 18 months, while solar output will jump 34%. Hawaii's rooftop solar power capacity is rapidly closing in on 200 megawatts, up from near zero 5 years ago. More than 12% of customers of the state's largest utility, Hawaiian Electric, now generate their own electricity this way. And when that company is merged into America's largest renewable energy producer, NextEra Energy, later this year, that rate of growth will accelerate even more. Even in Texas, heart of the oil patch, wind energy has doubled its market share in less than 5 years and now accounts for more than 10% of electricity generation in the state. New transmission lines connecting windswept areas to the Lone Star State's major cities promise to take that share up several more notches by the end of the decade. The U.S. Energy Information Administration's definition of renewable energy includes everything from giant hydroelectric dams to wood biomass and ethanol. Together, all of these sources generated 12.5% of U.S. electricity in 2014, boosting their output a little less than 5% over the past 2 years. That's respectable at a time when overall U.S. electricity demand has actually dipped. But strip out the traditional sources, and you'll see growth in wind and solar that's been nothing short of spectacular over that time. Since 2013, wind generation has risen 15% nationally and now accounts for nearly 20% of all renewable energy. Solar generation is still only about 5% of total renewable power, but it's rapidly closing the gap, boosting output nearly 70% since 2013. That kind of growth adds up to real money for the energy companies behind it, and the stock market has noticed as investors have driven up prices of popular wind and solar companies into the stratosphere. Take Solar City, the nation's leading installer of rooftop solar systems. Today, the company's shares sell for nearly 7 times their price at their initial public offering back in December 2012. And Chairman Elon Musk's early investors are hardly unique in their good fortune. Shares of slightly larger Sun Edison today sell for 15 times more than they did as recently as mid-2012. Meanwhile, a new breed of renewable energy yieldcos has taken Wall Street by storm. Spun out from renewable energy developers in a series of initial public offerings the past couple years, yieldcos control portfolios of wind and solar plants. Sales are guaranteed at premium prices under contracts that typically last 20 to 30 years. And the more plants yieldcos build or buy, the more their cash flows go up and the fatter their dividends grow. In the early 1980s, the budding renewable power industry of the previous decade was killed off by falling oil prices and a hostile Reagan administration. But so far this time around, plunging oil and gas prices have scarcely made a dent in renewable energy growth. One reason is, with the exception of a handful of isolated markets like Hawaii, oil's no longer an important competitor in generating electricity. Natural gas is, but despite a more than halving of gas prices over the past 12 months, new renewable energy projects are still being proposed and getting built. In fact, the pace has arguably accelerated, even as activity elsewhere in the energy patch has screeched to a halt. Those are big positives in an uncertain market, and it's no great surprise renewable energy stocks are benefiting. There is, however, another side of renewable energy. Let's start with cost. Over the past decade, technological advances have slashed the cost of generating electricity from wind and sun dramatically. Yet, the more systems have come to rely on these sources, the higher customers' bills have climbed. An automaker in increasingly wind and solar reliant Germany, for example, today pays more than 4 times as much for its electricity as rivals do in the U.S. Southeast, where utilities rely on natural gas and nuclear energy. And as a result, global industrial giants are coming to places like the Carolinas and the U.S. Gulf Coast as never before. Southern state utilities like Duke, Entergy, and Southern Company are seeing record levels of growth in industrial demand. Despite industrial company defections, German government support of renewable energy remains strong. Australia's recently elected Liberal Party government, however, has rolled back policies of the previous Labour Party that favored wind and solar. That country's leading generator, AGL Energy, is still pushing ahead with 2 large solar plants that will open for business later this year. But without government support, the pace of new projects has ground to a halt in Australia, and even AGL has hedged its bets well, completing an acquisition this year that's made it the country's largest power producer from fossil fuel plants. As yet, we haven't seen a full-scale ratepayer revolt against renewable energy costs in the U.S., but there are definitely rumblings against renewable portfolio standards in states where support at one time was basically unconditional. This month, for example, the state of Idaho cut the required length of contracts for new renewable energy plants from 20 years to just 5. Regulators may cut that to 2 later this year. After that, any new wind and solar facilities built will have to compete to win the business of Idaho Power and other large users. Cutting contracts length could potentially cut the legs out from under new renewable plant economics in Idaho. More important, it highlights just how vulnerable wind and solar power development is to government policy, from mandates that require their use to increasingly at-risk tax incentives. Solar tax incentives, for example, are set to expire at the end of 2016 in the U.S., and the fate of President Obama's reduction plans for carbon dioxide emissions from power plants clearly depends on who wins the November 2016 presidential elections. The biggest risk to renewable energy growth now is simply that wind and sun are intermittent resources. In other words, the wind isn't always blowing, and the sun isn't always shining. And the more a community relies on them, the greater the challenge of having enough alternative supplies to keep the lights on when they're not. Even states where governments are unquestioningly pro-renewable energy, like California, are considering new limitations and fees to slow the rapid growth of sources like rooftop solar. And the more they react, the greater the danger to renewable energy developers. The upshot is there's still money to be made in renewable energy, but not every company is going to prosper. Gone are the days when any renewable energy exchange traded fund will make money consistently. Selectivity has become critical and will be ever more so in the coming years. Think of it as good renewable energy versus bad renewable energy. Good renewable energy companies are establishing dominant niches in areas with clear paths to future growth, and they're anchored by strong balance sheets and secure long-term contracts with the most creditworthy customers on the planet, namely regulated utilities and governments. Bad renewable energy is all flash. The ideas are big, and the stock prices are stratospheric, but the profits, if they exist at all, are minuscule. In many cases, there's cutthroat competition from countries where almost anything can be done more cheaply and just as efficiently. Where there are contracts, they're typically with counterparties 1 or 2 fault steps away from defaulting. Balance sheets, meanwhile, are laden with debt and potentially restrictive covenants with lenders. Not to mention off-balance sheet items most investors never find out about until it's too late. Thus far in the renewable energy investment boom, investors have been easily swayed by promises, even to the extent of ignoring companies' actual profits. That's the same formula for disaster that led to the 2000-2002 tech wreck. And it's what lies in store for those who don't choose their renewable energy stocks carefully. Choosing the best of every energy sector is what we do at Energy and Income Advisor. And in early March, our subscribers will receive my special report, Good Renewable Energy, Bad Renewable Energy, highlighting a clear path to getting the best from this sector while avoiding the coming flameouts. I highlight the best renewable energy stocks to buy for outsized total returns now, including a yieldco owner of renewable power plants and transmission lines on track for 20% plus annual growth from its locked-in 2015 dividend of nearly 6%. This one has already netted us a 30% gain, but there's much, much more to come. You'll also read about my favorite solar components maker, which is underpricing the competition and winning markets, as well as America's best and cheapest rooftop solar stock that won't melt away if government support does. And I also highlight a handful of winning future technologies backed by companies with staying power, which I uncovered at the annual ARPA-E conference. As for the worst of what renewable energy has to offer now, at the top of my list are so-called yieldcos that pay little or no real yield and are unlikely to ever. A commodity-based solar company whose already negative profit margins are actually widening even faster than its sales are growing. And a popular ETF that looks set to blow a giant hole in the portfolios of thousands of investors in the next 12 to 18 months. Being selective is what we do at Energy and Income Advisor. We were among the very few on either Wall Street or in the investment publishing industry to forecast declining oil prices in 2014. And we were able to point our readers to opportunities in downstream companies that have since profited richly from lower energy prices. Our readers were also able to book big profits in leverage stocks like offshore driller Seadrill well before they crashed. More recently, we've been preparing our readers for the next great energy market disaster, a meltdown of bad midstream companies set for dividend cuts, unfortunately to the surprise of many investors who continue to mistakenly believe all pipeline stocks are impregnable. Our good midstream companies will weather this crisis, even as they grow dividends and take advantage of weaker rivals to build their businesses for the future. And that's exactly what the good renewable energy companies in my report for EIA readers will do, even while the sector's flashy fare go up in smoke. It's all here for you with a subscription to Energy and Income Advisor. Please click on the green button below to find out more. And thank you very, very much for your time.